Okay, welcome to another run through of the weekly S&P 500 chart storm. Probably of a little bit more interest than usual given what happened last week, which I'm sure you're all across by now, but we'll kind of get into it anyway. First is Happy New Month. Hopefully it's a little bit happier than last month, but anyway, this is an interesting chart and probably worth briefly talking through because, for those who are not aware, there's this thing called trend indicators. And the 10-month moving average, this is a monthly chart. So 10-month moving average, that's basically the 200-day moving average, very popular trend indicator. It's quite a popular tool for, kind of what you might call dumb market timing. And I'll explain. So for those that are looking to, reduce downside capture, a popular strategy or semi-popular strategy is to say if price lower than 200-day moving average equals sell or underweight. If price greater than 200-day moving average, then buy or overweight. And so let's look at it. So when prices cross below the 10-month or 200-day moving average, you'll notice here that if you only looked at the last decade, or the decade and a bit really, then you'll notice that there was like a breakdown here, and that kind of looked like a buying opportunity. And again there, and again back in 2016, 15, and again in 2011, 2012, I think that 2010. So if you only looked at it, if this was like the data that was your machine was learning on, then you would be thinking, oh, whenever price goes below 200-day moving average, then it's a buying opportunity. But if you go back a little bit further and populate your bear market scenarios, you can go back to 2000 there, 2001 I think it is actually, where it crossed below and stayed below, had a basically a selling opportunity, you might call, if you flipped it on its head. In 2002, before the bear market had its last gasp, and then of course into 2007-08, that rule would have actually gotten you out of most of the major down move in 08. So it's an interesting indicator there, and I guess the key takeaway there is, like all trend indicators, like quantitative trend indicators, it will be effective at certain times and but not effective at other times. But the fact that it's crossed below, that's certainly interesting, and I think that certain funds will be acting on that. Anyway, at number 2, history made. Fastest 10% decline in the S&P 500 from a record high. Not really much to add from that. Just an interesting chart, really. More history made. So this is the largest S&P 500 ETF SPY. Became the first security to ever trade over $100 billion in a day. Interesting. Next one. Speaking of value traded, this one's probably a little bit more interesting, actually. Short ETFs saw a surge in Thursday, Friday to levels last seen in 2011, back when the US sovereign credit rating was downgraded. Credit ratings, remember when those things mattered? So leveraged ETF trading. So what I've done with this chart is I've basically added up all the value traded for US equity ETFs that are, inverse ETFs. As you can guess, as you might have been able to guess, there was a big surge in value traded on those late last week. This tends to work as a contrarian indicator for reasons that you should be well aware. Basically, if people are piling into these, then market's basically in panic mode. The crowd tends to be wrong at extremes, and so if this is a run-of-the-mill correction sell-off, then this is one of the things that you'd expect to see spiking as a contrarian buying indicator. Of course, 2008-09 gave us a bit of an example of how it can actually just be the first sign of a, massive capitulation, rush of selling. The next one is kind of similar actually, but quite different. So this is the implied correlation index. It's worked out based on option prices, so very kind of similar to the implied volatility index. Now, the reason why this one might work as a timing indicator is because correlations tend to spike into a correction. So this is inverted, by the way. So implied correlations went up, and that would make sense because in a true panic scenario, everyone just sells everything, and so everything becomes more correlated. Versus, around market peaks, it often tends to be that it's just a few things that are kind of driving it, or that people are kind of piling into one particular sector, or indeed, rather than buy every single stock, they might just buy the top, the largest stocks, and that will show up here. So yeah, in terms of this, like, it's no hard and fast level. It's more about the movement in this one, because you can see that there was basically a buying signal triggered when it moved down to that level there in 08, I think, or 09, and then again in 2010, 2011, 12, there, different levels again, and then, again in the recent years, different levels again. But the point is that it's gone to a high level, then it's really, or a low level rather, and then it's shifted significantly. And that's basically a contrarian buying signal there. Again, these kind of contrarian buying signals can be they can be early, or they can kind of not work if it's a bear market, or they can just be super short term. So it's like you get a contrarian buying signal light up, and the market bounces and then carries straight back on down. So number 6 here, we've got VIX futures curve in panic mode, and the RSI is technically oversold, and we've got a volume spike, which overall is indicative of capitulation. And I mean, this is basically a textbook case study of market capitulation, or selling capitulation here. Yeah, fairly textbook oversold signal from the RSI there, and the VIX futures curve. So that's the ratio of VXV 3-month VIX versus spot VIX, and you tend to see that works as a bit of a contrarian buying signal there as well. So yeah, a lot of signals pointing to high probability of a bounce this week. Here's an interesting one. So this is the low volatility ETF. So if you like factors, or if you're wondering what this is kind of like one of those factor ETFs or styles. I don't know. I kind of treat these sort of things with a bit of skepticism. I think, getting too, scientific, or too clever about sectors and styles can lead to people thinking that they're smarter than they actually are. And we've got a case of that, study of that here. So the low volatility ETF actually underperformed the S&P 500, but day to day, I'll show you this here. So I don't know if this is going to show up on the screen properly. How about we just take a snap of that and move it over a bit. Whoops. Oh, I'm making it right. Bugger up of that. Anyway, we've got here, I hate that stupid little Windows thing that makes it. Anyway, yeah, so you can see here that the low volatility ETF did actually outperform SPY initially. So we've got the ratio. So, that's a little useful trick here. Stockcharts.com, extremely useful website. So you put in the ratio of one stock or ETF to another. You just put the code in, colon, another code. And so, yeah, going into the initial part of the sell-off, the low volatility ETF did actually outperform a bit, but then ended up not, or significantly underperforming on Friday, which, you actually saw fairly similar price action on a couple of other things of this kind of nature. So we saw it in REITs versus S&P 500, gold miners, gold itself, and also like utilities versus S&P 500. So what that tells you, what that tells me, is that people were, basically cashing in on their hedges, and probably would have made sense to do so going into the weekend. I think, it's just broader squaring up. It's a thing, gold, it will spike into the initial phases of correction, but then people will turn to gold as a funding source. And that's actually a Twitter comment I made before, is a little conversation I was having, is that times like this, you will actually tend to see a bit of buying and selling flow from real money asset allocators. I used to work for a large asset allocation fund, and basically, if you're a 60-40 fund, and it's very simple, bonds went up about 5% last week, unleveraged, right? And then equities were down about 10%. And so if you're a 60-40 fund, that would mean that you would have ended up drifting away from benchmark by about 3 or 4%. So they would have ended up overweight bonds and underweight equities at the end of the week if they had no hedging, if they had no active manager offset, and if they did nothing. So, a lot of those kind of funds, they have a mandate or an investment policy that says if, market value of portfolio is different from benchmark, and then sell or buy to bring it back to benchmark. And so what that would mean is that, those kind of funds would have to do some pretty heavy selling of treasuries and pretty heavy buying of equities to bring that back to benchmark. So that's actually, a source of potential buying this week, as well as, people that are looking at these kind of charts from before and thinking maybe it's time to have a wee crack. Number 8, S&P 500 closed the day, week, month below its 200-day moving average, as we discussed at the start. And at this point, only 23% of stocks are still trading above their own 200-day moving average. So this is, this is kind of like a oscillator as well. So you could call that fairly washed out and oversold. And certainly that's what it how it acted in the previous corrections over this time period. Of course, going into a bear market, you'd see similar activity, and it would stay oversold. And we'll notice that on the next chart, actually. Similar, but with a global perspective, few countries are unscathed by the global equity market capitulation. So we've got here global equities breadth. So what I've done with this indicator, I've taken the main benchmark of 70 countries and applied the same methodology. So percentage of countries that are trading above their own 200-day moving average. And you can see there that it collapsed from fairly strong levels. And yeah, so if you don't get a bear market, you can see there that in 2015-16, again in late 2018, this indicator actually worked as a pretty good buying indicator when it got completely washed out. And by the way, the full definition of the rule in that situation, and also back there in 2011, the full definition of the rule for a true oversold signal is that it goes down to washed out levels and then actually turns back up. And that would actually kind of help you avoid perhaps getting the wrong signal back in 2000s and 07, 08, where it became very washed out and stayed that way as market prices collapsed. So it's yeah, it's quite interesting just to see how that's unfolding across the world. It's also interesting too to highlight, just see that grey line there, that's the MSCI ACWI, so MSCI All Countries World Index ex-US, and you can see there that it looks very different from the black line, which is having a quite a heavy weight to US equities there. And um, well, there's a lot that we can say about that, but I won't cover that here. I've already talked about a lot elsewhere. But finally, number 10, fun fact. Last month, the implied forward-looking equity risk premium, so equity risk premium is the expected or realized or prospective return of equities versus risk-free asset. In this case, we might call it treasuries. So, and the way that we are calculating this is expected returns on US equities minus treasuries was minus 2%, and now it is positive 2%. So let's have a look here. Yeah, so this is an extract from my capital market assumptions. I calculate this for 20 odd, I think close to 30 different asset classes. Basically, the purpose of this is really to plug into an asset allocator's mean variance optimization. Basically, they use it for as a reference point to put together a benchmark asset allocation which is designed for a 5 to 10 year time frame. And a lot of those kind of funds would do set and forget. They might set in their asset allocation based on these kind of inputs and then leave it that way, or they might dynamically allocate around it. But anyway, so we've got here expected returns over a 5 to 10 year time frame. There's a lot that we can say about this chart, but I'll just focus on the equities versus treasuries aspect. So treasuries, your long-term expected returns really are simply the yield. The yield is basically the best indication for a long-term return expectation, because if you buy and hold and don't sell or don't mark to market or anything like that, and you just wake up at the expiry or the maturity of your bonds, then your return is the yield that you started with. For equities, it's a little bit more complicated. It's made up of things like dividend yield, of valuation mean reversion, and trend earnings growth. But anyway, we've gone from this time last month, equities, US equities was actually a small negative just because of where valuations had got to, and treasuries were obviously a lot higher. So it's quite interesting, it's interesting that you expect these kind of things to prove their worth over the longer term time frame, but noticing the negative equity risk premium on this basis at that time last month was turned out to be quite a good forecast. So now it's interesting that it's gone back the other way. So over a long run and ignoring volatility, you'd expect equities to outperform treasuries. So that's probably a good place to end it. I mean, just some final thoughts there. A lot of these indicators, as we've kind of talked through, are looking quite oversold. The odds of a bounce, I would say, are very high. I would probably actually be more surprised this week if prices just ended up, going further down. Like if Monday, Tuesday, Wednesday were all negative, to me that would be extremely surprising. That would be pretty much unprecedented. But that doesn't mean that we can just, be blindly bullish either, because if you look in late 2018 here, this is kind of the cautionary scenario. So you got oversold signals from the VIX curve indicator and from the RSI kind of earlier on in October there. big old bounce, which is very nice if you're just a short-term punter, short-term trader. That would have been quite nice, but then you just had this ranging, chopping action before it went and did another leg down. So that really is the cautionary. And back there in early 2018 as well, you had that strong oversold signals, got a decent bounce, but then again, it took, almost, quite a large period of time before it did actually go on to make a new high. So that's kind of the cautionary there, is that, you know, short-term bounce does not mean bull market. What are the things outside of technicals that I'm focused on, or that, would drive a more meaningful shift in risk sentiment or more meaningful run in equities? That would be things like, coordinated central bank action, or one big central bank taking action, or, some sort of news development with the virus. Obviously, I mean, with the virus, I've kind of been thinking about it, and, if we get more bad news, I don't actually know how potent that will be to push stocks further down. And here's why. I think, the market's already really priced in a lot of that bad news already. So, if you get more scary statistics in the headlines, maybe the market doesn't even move that much. Maybe it needs to be, significantly more dire to actually move the dial here. Um, but, um, the all clear from the virus aspect would be, that the pandemic's run its course, but that'll take some time. Other things would be, some company comes up with a vaccine and that gets mass produced and rolled out and it's 100% effective. That'll shift the sentiment a bit there. But, the other things that we've got going on is some aspects of the global data had been going a bit crappy. We've seen quite recessionary data on a number of fronts. The soft data has actually turned around already. So, a continuation of improvement in the soft data would be encouraging. Probably unlikely because, you're going to have this scary news headline effect on that. And also the China virus shutdown is obviously going to make its impact felt. It's already seen that in the China PMI. So there's that. And then there's the primaries, of course, as well. Sanders looks like the front runner. We've got Super Tuesday this week. That's another big, important, potentially complicating factor. If Sanders comes through and that is still the front runner and gains, significant ground against the other guys, then that could actually be a bit negative because, um, there is one school of thought that says, okay, Sanders is, going to spend a whole bunch of money on social programs. That's going to boost demand. That's going to be good for the economy, good for earnings. But most of the stuff that he talks about is quite negative for markets. Generally, the further left leaning the government, the more business unfriendly it is. And I think that that's kind of like the safe assumption. So if it becomes, crystal clear that he is the front runner, then that kind of, and that's quite negative really for stocks in that narrow window or that narrow lens. If on the other hand one of the other guys comes out on top through Super Tuesday, or it makes the outcome a bit less of a done deal for Bernie, then that could actually introduce at least a little bit of a positive dynamic into the market there. So that's definitely something to keep an eye on as well. So yeah, I guess, and I mean, from my point of view, I'm still bullish medium term. I don't think that we're in a bear market because a bunch of things that lead me to believe that, but that's a topic for another time. Short term, I would say we're probably going to get a bounce this week, but there's a lot of things to keep an eye on and a lot of things to keep monitoring.